In September 2008, the United States came within days of complete financial collapse. Not a recession, not a downturn, complete collapse. ATMs were going to stop working. Payrolls were going to stop processing. The global financial system was hours away from freezing entirely. Most people have heard of the 2008 financial crisis. Almost nobody understands what actually happened. This is that story. To understand 2008, you need to understand one financial instrument, the mortgage-backed security. It sounds complex. It is not. Here is the basic idea. A bank gives someone a mortgage. Instead of holding that mortgage and collecting payments for 30 years, the bank sells it. It bundles thousands of mortgages together into a single security. Then it sells that security to investors, pension funds, foreign banks, insurance companies. The investors receive the monthly mortgage payments. The bank gets cash up front and can make more loans. On paper, this looks brilliant. Risk is spread across thousands of investors. Banks stay liquid. More people get mortgages. And it worked for a while, until it didn't. Three things combined to create the 2008 crisis. The first was a housing bubble. From 2000 to 2006, U.S. home prices rose by roughly 90%. People believed house prices only go up. Banks believed house prices only go up. Investors believed house prices only go up. Everyone was wrong at the same time. The second ingredient was subprime lending. To keep up with demand for mortgage-backed securities, banks needed more mortgages to bundle, so they started lending to people who could not actually afford the loans. No income verification, no asset checks, loans with adjustable rates that would explode after 2 years. These were called subprime mortgages, and the people selling them knew many borrowers would eventually default. They sold them anyway. The third ingredient was complexity. The mortgage-backed securities were repackaged, sliced and repackaged again, into instruments so complex that even the people selling them did not fully understand them. They were given AAA ratings by credit agencies who were paid by the same banks selling the products. The conflict of interest was enormous. The oversight was essentially zero. Here is where the story turns criminal. Credit rating agencies are supposed to be independent. Moody's, S&P, Fitch. These organizations exist to tell investors how risky a financial product is. AAA means almost no risk of default. The same rating as U.S. government bonds, mortgage-backed securities filled with subprime loans, loans given to people with no income, no job, no assets, were receiving AAA ratings. Why? Because the banks paid the rating agencies to rate their products. If one agency gave a lower rating, the bank would take its business to a competitor. The agencies were competing to give the highest possible ratings to keep the fees flowing. It was not an accident, it was a design, a system where everyone in the chain had an incentive to pretend the risk was lower than it actually was. The mortgage broker got paid to make the loan. The bank got paid to bundle and sell the security. The rating agency got paid to give it a high rating. The investor, often a pension fund managing the retirement savings of ordinary Americans, was left holding the risk that nobody had honestly disclosed. In 2006, home prices peaked and began to fall. Adjustable rate mortgages began resetting to higher rates. Borrowers who could barely afford the original payment could not afford the new one. Defaults began rising, first slowly, then faster, then suddenly. By 2007, the mortgage-backed securities that had been rated AAA were worth a fraction of their original value. Financial institutions that had loaded up on these securities were facing enormous losses. But here was the terrifying part. Because of the complexity of how these securities had been packaged and repackaged, nobody knew exactly which institutions held how much toxic debt. Banks stopped trusting each other. Overnight lending between banks, the most basic function of the financial system, froze. If banks cannot lend to each other overnight, the entire credit system stops. In September 2008, Lehman Brothers, one of the largest investment banks in the world, collapsed. $600 billion in assets, gone in a single weekend. The following week, the global financial system came within hours of total failure. The government's response was the Troubled Asset Relief Program, TARP. $700 billion authorized by Congress to stabilize the financial system. The banks that had created the crisis were given public money to survive it. Not the homeowners who lost their houses, not the pension funds that had been sold fraudulent securities. The banks. The Federal Reserve also stepped in with trillions more in emergency lending and asset purchases. This is where everything we have discussed in this series connects. The money printing that followed 2008, which we covered in Video 3, was a direct response to this crisis. The wealth inequality that accelerated after 2008, which we covered in Video 7, was a direct consequence of who received that money. The Cantillon effect, which we covered in Video 5, explains exactly why the recovery was so unequal. The financial institutions closest to the money received it first. Asset prices recovered. The stock market recovered. The wealthy recovered. For the bottom half of Americans, the recovery took nearly a decade. For some, it never fully came. Here is the number you need to know. The 2008 financial crisis caused approximately $10 trillion in lost household wealth. 10 million Americans lost their homes. Unemployment peaked at 10%. And the number of financial executives who went to prison for creating the crisis. 1. A minor trader at Credit Suisse, not a CEO, not a ratings agency executive, not a mortgage originator who handed loans to people with no income. One person, for a crisis that destroyed the savings of millions. The system that rewarded everyone for taking risks on the way up provided almost no accountability on the way down. And the people who received government money to survive the crisis paid themselves bonuses that year. The 2008 crisis was not a surprise. It was a predictable outcome of a predictable system. A system where incentives were misaligned at every level, where complexity was used to obscure risk, where the profits were private and the losses were public. You now understand what happened in 2008. But more importantly, you now understand the system well enough to recognize when it's happening again. Subscribe if you want to keep following where the money goes. Because the patterns of 2008 have not disappeared. They have evolved.